Joining us now, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. So your forecast for the year, Lori, you're looking for 7, 8, or 9% gains in equities this year. Everybody's right in that range. Are you too? It's January, and I don't envy your job trying to do it. But if everyone's at 7, 8, or 9, it's probably not going to be 7, 8, or 9. It could be down. It could be up 25.
No, look, I think that we view price targets as a compass as opposed to a GPS, right? They're a statement of direction of travel. Are we bullish? Are we not? And why? Our number is 77.50 for year end. It's a 12-month price target. We have 5 models that go into it. If you look at it relative to the December 31st close, we were actually one of the higher numbers on the street with about a 13% gain. And what I think is important about that 13% number, Joe, is that if you look at bottom-up consensus earnings growth in the S&P 500, at the time we put this target together, that implied earnings growth rate from the consensus numbers was about 13%. It's now drifted up to about 14%. But more or less, our appreciation forecast in terms of price is right in line with that earnings growth number. So we're not looking for multiple expansion. We're not looking for a big decline in the multiple. We think this market is going to get what it deserves, but from an earnings perspective.
That is the way I've been thinking about it, too, when we have people on it and myself. First, you'd have to decide, will multiples contract because they're a little bit rich? And if you decide, well, rates are coming down or at least maybe staying where they are, I don't know what the Fed does. But let's say that multiples only come down 1 or 2 percentage points. If you're getting 14% earnings growth, which is, I think, easier to quantify, hopefully, unless there's something looming that we don't know about. But if you do 14%, the market should be able to trade higher just based on that. I don't know how much.
No, I think that's fair. And, I won't nerd out with you too much just in terms of our modeling, but we do have one of the 5 models is based on valuation and earnings. And we actually use inflation forecast, Fed fund forecast, and 10-year yield forecast, just the consensus numbers, not Lori making up her own thing. And when we put those numbers in, and it's like a 2.7% inflation rate on the average for 4Q, like one more cut from the Fed, and 10-year yields basically staying flat. When we do that math, our regression analysis, which goes back to 1962, suggests that the PE multiple should stay flat with where it was in 2Q. So, we have these, kind of general ideas of what we think the market deserves to do, but we have actually kind of dug in and really looked at some of the math that also justifies that idea as well.
That's pretty interesting and useful. I think that it's actually a rigorous way of saying multiples probably don't necessarily rise, but don't contract. I could make a case for multiples even rising with AI or productivity or inflation being more under control than people think. So then any risk really is that we're miscalculating earnings per share growth. We could be thinking it's more than it's going to be, or we could be underestimating. If it's 4% GDP, earnings per share growth could be even higher than 14%.
I think that's a good way to look at it. I think that's one of the wild cards you have to look at. And frankly, when we dig into the earnings number, one of the things that's given, kind of the top-down forecasting community trouble with forecasting earnings in recent years are the margin assumptions, because we've just been seeing tremendous margin expansion. And I will tell you, as someone, I use the bottom-up consensus now. I used to try to do my own earnings forecast top-down, and the margin issue was always very tricky because any sort of macro variables that helped explain margins in the past just don't work anymore. And I think that's because we're in this sort of renaissance of productivity and technology, not just the tech companies expanding their margins, right, but other companies using these tools as well. And that's why I think earnings have been so resilient. And, you do kind of have a bias that they're going to meet those numbers or perhaps surprise a little bit.
And those could be positive things for margins. And then you got tariffs, which could be, were forecast to be really negative for margins because people were or companies were eating some of the tariffs, not necessarily passing them on immediately. So that was on the flip side. You don't think that's going to be an issue?
Well, it's interesting, Joe. We did a little bit of an experiment with the 3Q data. So we looked at the consensus margin assumptions by sector and how they were ahead of the 3Q reporting season and then where they ended up. And the overall S&P 500 number didn't move that much, but if you looked at the sectors themselves, we saw tech come in well ahead of expectations. There's one other sector, I think maybe materials, that came up. And then we saw, some of the other tariff related sectors like industrials actually come in lower. And so kind of the strength that you were seeing in kind of that AI part of the economy was offsetting some of the hits that you took from tariffs. And the hits from tariffs weren't terrible, but it was interesting when you really kind of dug into the guts of those numbers, how one issue offset the other.